For most of the financial world, silver remains one of the most misunderstood assets in the global commodity complex because while mainstream investors continue concentrating capital into overcrowded technology equities and artificial intelligence momentum trades, a far larger structural opportunity is quietly developing beneath the surface as central banks accumulate precious metals. Sovereign debt burdens spiral toward historic extremes. Industrial demand for conductive materials accelerates through electric vehicles, semiconductor manufacturing, military systems, renewable energy infrastructure, and solar technology expansion, all while silver uniquely functions as both a monetary reserve asset and a critical industrial metal, creating a rare dual demand structure capable of generating one of the most explosive commodity supercycles of the modern financial era, particularly because the silver market remains dramatically smaller than gold, meaning even moderate institutional inflows can create violent price appreciation once investor psychology shifts from indifference towards scarcity awareness and inflation protection. Among the companies positioned to potentially benefit from this structural repricing event, Aya Gold and Silver stands out as one of the most strategically undervalued opportunities because the company controls an exceptionally high-grade primary silver operation in Morocco at a time when true primary silver miners are becoming increasingly rare across global markets. And unlike low-grade mining operations vulnerable to energy inflation, labor cost escalation, and margin compression, Aya possesses the operational advantage of extracting significantly greater revenue per processed ton while simultaneously expanding exploration programs that continue identifying additional mineralization zones, thereby increasing the probability that future reserve growth could force institutional investors to eventually revalue the company not merely as a regional producer, but as a strategically important long-duration silver asset capable of generating exponential cash flow expansion during a sustained silver bull market. Historically, the largest fortunes created during commodity supercycles did not emerge from owning the underlying metal itself, but rather from identifying undervalued mining companies before institutional recognition arrived. Because when silver prices rise from one major resistance level to another, mining companies with scalable production and controlled operational costs often experience profit growth many times greater than the percentage increase in the commodity price itself, which explains why previous precious metal cycles produced mining equities that appreciated thousands of percent as capital rotated away from fiat-dependent financial assets and toward hard resource exposure. And with today's global environment increasingly characterized by monetary debasement risk, geopolitical fragmentation, declining confidence in sovereign currencies, and rapidly tightening physical silver supply conditions, the possibility that select overlooked silver equities could eventually generate extraordinary multi-decade returns is no longer a fringe speculation, but an emerging macroeconomic probability that Wall Street still appears dangerously unprepared to recognize. While the overwhelming majority of Wall Street analysts continue focusing their research coverage almost exclusively on mega-cap technology corporations, artificial intelligence infrastructure giants, and highly liquid index-driven equities, a far more asymmetrical opportunity is developing quietly inside the global silver mining sector, where select companies possessing scalable reserves, expanding production capabilities, and strategically important geological assets remain dramatically undervalued relative to the magnitude of the macroeconomic transformation currently unfolding across international financial systems, because the world is simultaneously entering an era defined by persistent sovereign debt expansion, weakening purchasing power of fiat currencies, aggressive central bank liquidity interventions, rapidly accelerating electrification programs, rising geopolitical fragmentation, supply chain nationalism, renewable energy infrastructure expansion, and increasing industrial dependence on conductive metals used in solar panels, semiconductor architecture, advanced military hardware, medical technologies, electric vehicles, and next-generation battery systems, all of which collectively create the foundation for a structural silver deficit capable of driving prices substantially higher over the coming decade. Yet, despite these converging pressures, the majority of institutional capital has still not meaningfully entered the sector due to liquidity concerns, limited analyst coverage, and a widespread psychological bias created by years of suppressed silver performance, thereby creating the exact type of early-stage market inefficiency historically responsible for producing extraordinary wealth creation opportunities during previous commodity supercycles, when sophisticated investors positioned themselves ahead of the mainstream financial narrative and accumulated high-quality mining assets before broad institutional participation caused valuations to re-rate exponentially across the entire sector. One of the most compelling examples of this hidden opportunity is Aya Gold and Silver, a company that many sophisticated, resource-focused investors increasingly view as a potential institutional discovery candidate, because it controls one of the highest-grade primary silver operations currently available within publicly traded markets while simultaneously operating inside Morocco. a jurisdiction steadily improving its reputation for mining infrastructure, regulatory consistency, and long-term resource development stability, factors that become extraordinarily important once large-scale institutional money begins searching for concentrated silver exposure in a tightening global supply environment. And what differentiates Aya from countless speculative mining ventures is not simply the existence of silver reserves, but the combination of scalable production economics, high-grade mineralization, exploration upside, and operational leverage to rising silver prices. Because in mining economics, grade determines survivability during inflationary environments where fuel costs, labor expenses, and processing expenditures continue rising, meaning companies capable of producing larger quantities of silver from smaller volumes of extracted material possess structurally superior margins and greater resilience during volatile commodity cycles, while Aya's ongoing drilling programs continue identifying additional mineralized zones that could significantly expand reserve estimates over time, creating the possibility that investors currently valuing the company based only on present-day production metrics may eventually be forced to reprice the stock according to future reserve potential, long-duration cash flow expansion, and strategic scarcity value once the broader market begins recognizing how few pure primary silver producers actually exist globally. The historical record repeatedly demonstrates that the most explosive gains in commodity markets occur not during the late stages of public excitement when financial television networks aggressively promote the sector and retail investors flood into already overextended assets, but rather during the early accumulation phase when skepticism dominates sentiment. Analyst coverage remains minimal, institutional participation is limited, and valuations fail to reflect the scale of the coming macroeconomic shift, which is precisely why the current silver environment increasingly resembles the early foundations of prior resource supercycles that eventually produced mining equities capable of appreciating not by modest percentages, but by several thousand% over multi-year periods as inflation fears, currency debasement concerns, industrial shortages, and speculative momentum converged simultaneously into a self-reinforcing capital rotation toward hard assets. And because silver markets remain dramatically smaller than gold markets, relatively small inflows of institutional money possess the capacity to trigger disproportionately large price movements, both in the metal itself and especially in smaller cap mining companies, where liquidity constraints amplify upward momentum, meaning that if silver prices begin sustaining moves beyond major historical resistance levels, while industrial demand continues accelerating through electrification and renewable energy expansion, companies currently dismissed as niche speculative miners could rapidly transform into strategically significant resource assets commanding valuation multiples that today's mainstream analysts would likely consider unimaginable, thereby creating the realistic possibility that overlooked silver equities accumulated before institutional discovery may eventually become some of the highest performing financial assets of the next commodity cycle. Another silver company increasingly attracting the attention of sophisticated resource investors is Discovery Silver, a business that many mainstream market participants still underestimate, despite controlling one of the largest undeveloped silver resources in North America at a time when the global mining industry faces declining discovery rates, shrinking reserve replacement, and a growing shortage of economically scalable precious metal deposits. Because unlike traditional industrial businesses whose future growth often depends upon unpredictable consumer demand cycles, companies controlling strategically important mineral resources operate within an entirely different valuation framework where the long-term scarcity of the underlying asset can eventually dominate every conventional accounting metric used by Wall Street analysts. And in the case of Discovery Silver, the market continues valuing the company primarily according to present conditions rather than according to the transformational potential that could emerge if silver prices enter a sustained bull market cycle, driven simultaneously by industrial shortages, monetary instability, weakening confidence in sovereign debt markets, and accelerating demand from renewable energy infrastructure expansion, particularly as governments across the world commit trillions of dollars toward electrification projects requiring enormous quantities of conductive materials for solar systems, advanced transmission grids, electric transportation networks, battery storage technology, semiconductor manufacturing, aerospace engineering, and military modernization programs, all while the supply side of the silver market remains structurally constrained due to years of underinvestment in exploration and mine development, creating a dangerous imbalance between future demand expectations and available production capacity that could eventually force silver prices substantially higher and transform companies holding large undeveloped reserves into highly sought-after strategic assets, once institutional capital begins recognizing the scale of the approaching resource deficit. Equally important within this emerging silver narrative is Silvercrest Metals, a company that demonstrates why operational execution and disciplined management often separate extraordinary mining investments from speculative failures. Because throughout commodity market history, the greatest wealth creation has rarely come from simply owning deposits in the ground, but rather from identifying management teams capable of converting geological potential into efficient production growth, controlled operating costs, expanding free cash flow, and shareholder value creation during volatile market environments. And Silvercrest has increasingly distinguished itself through precisely those characteristics by developing high-grade silver assets with comparatively strong operational efficiency at a moment when inflationary pressures continue destroying margins across large segments of the mining industry, which matters enormously because as silver prices rise, the profitability of efficient producers can expand exponentially rather than linearly due to the fixed cost structure inherent within mining operations, meaning a relatively modest increase in silver prices can produce disproportionately large increases in earnings, cash flow, reserve economics, and ultimately equity valuations. A dynamic that historically allowed select mining companies during previous commodity supercycles to outperform not only the underlying metal itself, but nearly every major asset class globally as capital rapidly rotated away from overvalued financial instruments and toward hard asset exposure, and because the overwhelming majority of institutional investors remain heavily concentrated inside crowded equity trades linked to technology, artificial intelligence, and debt-dependent growth sectors, the possibility of a future capital migration toward precious metal miners remains one of the most underappreciated macroeconomic scenarios currently developing beneath the surface of global markets. The broader implications surrounding companies such as Discovery Silver, Silvercrest Metals, and Aya Gold and Silver is that the global financial system may be approaching the early stages of a profound monetary and commodity repricing cycle, unlike anything witnessed since the inflationary decades of the 20th century. Because for years, the international economy has been artificially sustained through unprecedented liquidity injections, near zero interest rate policies, expanding fiscal deficits, and exponential sovereign debt accumulation that collectively created the illusion of financial stability while simultaneously weakening the long-term purchasing power foundations, supporting fiat currencies worldwide. Yet, as inflationary pressures continue resurfacing across supply chains, energy markets, housing sectors, and industrial commodities, investors are increasingly beginning to recognize that hard assets possessing intrinsic scarcity characteristics may once again become essential stores of value within institutional portfolios, particularly when geopolitical fragmentation, trade conflicts, deglobalization trends, and strategic resource competition continue intensifying among major world powers. And within that environment, silver occupies a uniquely explosive position because it combines monetary credibility with indispensable industrial functionality, meaning any future convergence between investment demand and industrial consumption could generate supply pressures severe enough to trigger a historic upward repricing event across the entire silver ecosystem, thereby creating the realistic possibility that carefully selected silver mining companies purchased before widespread institutional discovery may ultimately deliver returns so extraordinary that future investors look back at the current period as one of the rare moments in financial history when transformational wealth generation opportunities were visible long before Wall Street fully understood what was unfolding.